Investing is important to financial success. If you don't invest to accomplish financial goals, you have nothing to show for a lifetime of labor. Remember, you don't want to invest your money just anywhere. You need to be smart about what you invest in so you can grow your wealth and become financially free. In this video, I'll teach you how you can invest smartly like Warren Buffett. Watch this video to the end. Let's learn some basic rules of investment. 1. Invest early. Starting early is one of the best ways to build wealth. Investing for long term is considered more effective than waiting until you have a large amount of savings or cash flow to invest. This is due to the power of compounding. Compounding is the snowball effect that occurs when the money you invest generates even more earnings. Essentially, you grow not only the original amount you invested, but also any accumulated interest, dividends, and capital gains. The key here is to invest as early as possible and as much as you can. So start early, grow it for a long term, and you'll become successful in your investment. 2. Have a plan. When markets turn choppy, even experienced investors can become too focused on short-term movements. This can lead to hasty decisions, especially trying to time the market. For example, investors see markets rise and jump in, buying high. This is fear of missing out, FOMO. Or they see markets fall, lose confidence, and sell at a loss. The key to avoid making rushed investment decisions is to maintain perspective and focus on the long term. With a good plan in place, you can stay committed to it and be successful. So have a plan, stick to your plan, and you'll be successful in your investment. So that is the second point. Have a plan and have a good plan, a workable plan that you can stick to and be successful. 3. Be ready to take risk. If you have a ton of money but keep cash under your mattress, that money loses value over time. This is due to inflation. If you want your funds to grow, you need to invest. So be ready to take risk with your savings. This does not mean pushing your savings into lottery tickets. Even if you have the potential to turn a $1 investment into millions, don't just do that. You need to take calculated risk. Risk can expose you to a degree of physical, financial, or emotional danger, yet they may be required in order to pursue new opportunities. Just know your limits and minimize it. Always remember to take calculated risk. Don't just take any risk. You need to know your limits, know how to minimize the risk, and maximize your profit. So remember, you need to be ready to take risk if you want to be successful in your investment. Number 4, invest regularly. Investing often is just as important as starting early and also having a plan and being ready to take risk. Having a disciplined approach can help you build more wealth over time. When you invest regularly, you can also ease into any type of market that is rising, falling, or flat. You don't have to worry about trying to find the perfect time to invest. By simply investing a fixed dollar amount on a regular basis, you can buy more investment units when prices are low and fewer units when prices are high. This can potentially reduce the average cost of your investment over the long term. Investing small amounts of money on a regular basis can help smooth out returns over time and reduce overall portfolio volatility. So you need to understand this, that investing regularly helps a lot, and you'll be successful when you do this the right way. 5, understand everything you invest in. You don't want to invest in anything at all. Don't invest in a product you don't understand, and ensure the risks have been clearly disclosed to you before investing. Whatever you are investing in, you need to understand how it works. If you are buying a stock, you need to know why it makes sense to do so and when the stock is likely to profit. If you are buying a fund, you want to understand its track record and costs, among other things. Investing involves an analysis of fundamentals, evaluation, and an opinion about how the business will perform in the future. Make sure the management team is strong and aligned with the interest of shareholders, and the company is in a strong financial and competitive position, says Graph. For more of such videos, subscribe to our channel and click on the notification bell so you don't miss any of our videos. 6. Diversify your portfolio. Minimizing investment risk means not only understanding how investments work, but also ensuring you don't put all your eggs in one basket. While you may have a particular company you love, if you push all your money into buying a stock and it turns out the CFO was just cooking books, you lose everything. To reduce the likelihood of big losses, spread your money around a mix of different assets. Keeping your portfolio diversified is important for reducing risk. Having your portfolio in only one or two stocks is unsafe, no matter how well they've performed for you. So experts advise spreading your investments around in a diversified portfolio. Mendiu said, "If I had to choose one strategy to keep in mind when investing, it will be diversification. Diversification can help you better weather the stock market ups and downs. Investing well is about doing the right things as much as avoiding the wrong things. In amid all of that, it's important to manage your temperament so that you are able to motivate yourself to do the right things even as they may feel risky or unsafe. So psych yourself, you know what you're going for. Plan ahead, stick to your plan, and be self-motivated. Go for what you want and you'll be successful investing. Follow these steps and enjoy investing. Make sure you keep it simple. It is very important to understand investment and do it the right way, and you'll be successful in life. Thank you for watching.